It's no secret that over the very long term, stock markets tend to go up. When compared to other asset classes like bonds or gold or real estate, stock markets have a very good long-term track record of providing positive returns for investors. But why? Why is it that stock markets tend to go up? Well, in this video, I want to get back to some of the basics and dig into the mechanics behind why exactly it is the case that stocks tend to go up in the long term. If you enjoyed today's video and haven't subscribed to the Investing with Tom channel already, please be sure to do so, but without further ado, let's get straight into the video. Now, as is often the case, the clearest example that I've seen of why stocks tend to increase in value in the long term comes from the world's best investor, Warren Buffett. In his 1990 letter to Berkshire Hathaway shareholders, he coined the term look-through earnings. Here, he explained that stock investors essentially earn a return in two different ways. Firstly, from dividends. This is simply just when a company pays a portion of their profits out to their shareholders in cash. And secondly, investors can earn a return through capital gain or price appreciation, which is really the main topic of this video. Now, the reason Buffett was discussing this with his shareholders in the first place back in 1990 was basically because when you looked at the income statement and the earnings for Berkshire Hathaway, only one of those two parts of the stock return equation was included in Berkshire Hathaway's earnings, and that is their dividend income. Buffett explained that the extreme case is Cap Cities ABC. Our 17% share of the company's earnings amounted to more than $83 million last year, yet only about $530,000, $600,000 of dividends it paid to us less some $70,000 of tax, is counted in Berkshire's generally accepted accounting principles earnings. The residual $82 million plus stayed with Cap Cities as retained earnings, which will work for our benefit but go unrecorded on our books. He argued that Berkshire Hathaway shareholders should include these retained earnings when calculating the true earnings power of Berkshire Hathaway. He said, "I believe the best way to think about our earnings is in terms of, quote, look-through results, calculated as follows. Take $250 million, which is roughly our share of the 1990 operating earnings retained by our investees, subtract $30 million for the incremental taxes we would have owed had that $250 million been paid to us in dividends, and add the remainder $220 million to our reported operating earnings of $371 million. Thus, our 1990 look-through earnings were about $590 million. So how does this relate to stock price appreciation? Well, the real key here is retained earnings. Retained earnings are what allow companies to continue reinvesting and growing their businesses, and ultimately they can result in capital gain and price appreciation, much like was the case for Buffett with his Cap Cities ABC investment back in 1990. Take the S&P 500, for example, a collection of America's largest and most profitable businesses. Now, according to figures put together by investment manager Chris Bloomstrand, in 2022, investors were willing to pay $19.20 for every dollar earned by the S&P 500 in aggregate. In other words, they were paying a price to earnings ratio of 19.2. Now, looking at that another way, if investors were to put $10,000 into, say, an S&P 500 index fund in 2022, the underlying businesses that they own through that index fund would have produced after-tax earnings of about $520 on the $10,000 investment. Now, of the $520, about $180 would have been paid to you as a cash dividend. However, that leaves $340, almost twice the amount you were paid as a dividend, being retained by that basket of companies in the S&P 500. Now, that $340 of retained earnings isn't dead money or some amount of money that's kind of stowed away out of sight by the business. Rather, it is reinvested in some way in the company for the benefit of you, the shareholder. Now, this reinvestment can come in many different forms. It can go towards building new factories. Take Tesla as an example of that, who've rapidly been expanding their ability to produce electric vehicles. It could simply go towards paying down debt. Take some of the big oil companies more recently, like Occidental Petroleum, who, as oil prices have been very high and as their earnings have been very high, have cleared a lot of debt off the table. It could go towards repurchasing shares and increasing the per share ownership in the business for ongoing shareholders. Take Apple as an example of that. Or it could even go towards acquiring acquiring either entirely or parts of new businesses. Take Warren Buffett's Berkshire Hathaway itself as an extreme example of that. Berkshire has never paid a dividend. They retain all their earnings, and Warren Buffett sits in Omaha and makes investments into other businesses to continue to grow the pie. And of course, these investments that companies are making don't all work out in all cases for all companies, but in aggregate, they do tend to produce good results. They allow the businesses to grow and become more profitable and therefore more valuable over a period of time. Over the long run, return on equity, which is a pretty good proxy for how well companies are investing these retained earnings over a long period of time, has averaged around 12% in the United States. That's essentially the return that management teams at these companies are getting on some of these long-term internal investments. And this continuous retention of earnings by companies in something like the S&P 500 essentially guarantee that over the long term, more and more capital, more and more money will be tied up in American businesses. And the more earnings that these businesses can retain and reinvest, the larger and more profitable they tend to get. Have a look at this chart of the S&P 500 earnings shown in orange here over the past 70 years. You'll see that they have steadily trucked up and up and up and up. And you'll also notice the second line in blue here, which is the price of the S&P 500, that has also tracked earnings right on upwards. So this continued reinvestment into US corporations in some of these examples, assuming that they're not going towards investments in projects akin to flushing money down the toilet, are really the mechanism behind continued growth in the businesses and in their subsequent stock prices. As businesses grow, so do their earnings and so do their stock prices. And that is why over the long term, as a general asset class, stocks go up. If you enjoyed this video and haven't subscribed to the Investing with Tom channel already, please be sure to do so. I would really appreciate your support. But that's all I've got for this one, and I'll see you in the next video. Cheers.